We'll now proceed to tackle accounting regulation, the whole network of bodies and rules that shape what financial reporting looks like in the United States and beyond. But before we dive in, can I be candid with you? This video has got a lot of acronyms and terms to memorize, and I'll admit it can be a little dry. So grab your favorite caffeinated beverage and pause the video every few minutes to do some jumping jacks to stay awake, alright? Okay, so you already know about the conceptual framework and the codification. So let's start with the people behind those, the FASB. The Financial Accounting Standards Board is a private, independent nonprofit that was established in the 70s. It has 7 voting board members with diverse backgrounds in accounting and finance. Their job is to research, debate, and ultimately establish and amend the codification. And they do that through Accounting Standards Updates, or ASUs. Alright, so now that we understand the FASB, let's hop in a time machine and head back to the 1930s. The stock market had crashed in 1929, the Great Depression was in full swing, and public faith in capital markets was completely shattered. Congress had to do something. So in 1933, they passed the first Securities Act, also called the Truth in Securities Law. This made the issuance of publicly tradable securities a federal matter instead of a state-by-state patchwork. It requires companies to register and file prospectus with financial disclosures before they get to sell securities to the public. It also prohibits fraud and misrepresentation in those sales. 1 year later, Congress went further with the Securities Exchange Act of 1934. This one is huge because it created the second major player in our regulatory framework, the Securities and Exchange Commission, or SEC. Congress handed the SEC sweeping authority over capital markets, and its mission is threefold: to protect investors, maintain fair and efficient markets, and facilitate capital formation. So here's a fun tidbit. The SEC technically has authority over US GAAP, but it delegates standard setting to the FASB. So while the FASB writes the rules, the SEC theoretically could step in whenever they wanted. The SEC is led by 5 commissioners appointed by the president. Now, you can imagine that if all 5 commissioners came from the same political party, things could get pretty lopsided pretty fast. So to keep politics from bleeding too far into their decisions, the law caps it. Only 3 of the 5 can belong to the same party. One of the SEC's biggest jobs is to require periodic filings from public companies. So we're going to take a step aside from regulators for just a minute and look at what those filings actually are. Form S1 is the registration statement used by brand new registrants, or by companies that have been filing with the SEC for less than 36 months. If you have ever read about a company going public, doing an IPO, then the S1 is the document that everyone digs into. There are other forms in the S family, like S4 for mergers and acquisitions, or the S8 for stock-based compensation, but we're not going to worry about those in this class. Once a company is public, the workhorse filings begin. The 10-K is the annual report. It includes the annual audited financial statements, management and auditor assessments of internal control effectiveness, and all other required disclosures. It is a meaty document. Now, the 10-Q is the quarterly cousin. It is a condensed version of the 10-K filed at the end of each fiscal quarter. And here's a key detail. The 10-Q does not need to be audited by an independent CPA firm. Now, at the time of recording this video, it's actually become a hotly debated topic whether we should require quarterly reporting or if we should make it semi-annual. There's legitimate arguments on both sides of the issue, and we'll discuss more of those during lecture. Next, some of the most important actions a company can take, like approving directors, these have to be approved by the shareholders. But most shareholders aren't going to fly out to attend a meeting, so management usually asks them to designate proxies for voting. The proxy statement, abbreviated as DEF 14A, is where you can find what is up for vote. Typical items include the election of directors, executive compensation, auditor ratification and audit fees, and any other shareholder proposals. If you want to know what a CEO actually gets paid, the proxy statement is where you can find their gold mine there. So annual and quarterly financials are great, but what about everything that happens between them? That is where the 8K comes in. The SEC requires prompt disclosure of significant events or material information that could impact investors. There's a lot of things that could require an 8K disclosure, but some important ones include earnings announcements, M&A activity, restatements, bankruptcies, or changes in leadership or auditors, just to name a few. And for the last couple of decades, all of these filings live in one place, EDGAR, which stands for Electronic Data Gathering and Retrieval. It's the SEC system for handling reports. It was designed to reduce the overwhelming flow of paper into the SEC. And now, all publicly held companies are required to file electronically through EDGAR. And the best part for you and me is that anyone in the public can access it for free. Okay, back to our regulators. The last domestic player to know is the PCAOB, the Public Company Accounting Oversight Board. It was established by the Sarbanes-Oxley Act of 2002, which Congress passed in response to massive accounting scandals like Enron and WorldCom. The PCAOB oversees the audits of public companies to protect investors and the public interest. It sets auditing standards for registered public accounting firms, and it also inspects those firms to check for compliance. It can also discipline firms and auditors that step out of line. So now let's zoom out. Everything we've talked about so far applies in the United States, where we follow US GAAP. But the rest of the world does things differently. US GAAP and international standards still differ in meaningful ways. And for more than 50 years, regulators have been working to narrow those differences. That work started with the IASC, the International Accounting Standards Committee, which was formed at the same time as the FASB to reduce global accounting diversity. The IASC could not require any country to adopt its standards, but the member bodies committed to working toward adoption, and standards are approved by a board representing 14 countries. Now in 2001, the IASB, the International Accounting Standards Board, replaced the IASC. And that same April, the IASB adopted all existing previous standards and renamed future standards IFRS, International Financial Reporting Standards. So how are we actually going to narrow this gap? In 2002, the FASB and the IASB signed the Norwalk Agreement, committing to make their standards compatible. And convergence can happen in three ways. FASB could adopt IFRS, the IASB could adopt existing US GAAP, or the two boards can work together to develop a brand new standard from scratch. And with that, I hope that you now have a better sense of the regulatory landscape that shapes financial reporting today.